Hey everyone, welcome back to the channel. Today I'm diving into whether now is the right time to invest in Exicom Tele Systems Limited. This company has been making waves in the EV charging infrastructure and power systems market, but lately, it's been on a roller coaster ride. Let's get into the details. First, let's talk about recent performance. Exicom had an impressive IPO in 2024, oversubscribed 129.52 times, and it listed with an 87% premium. However, since then, the stock has taken a nosedive, dropping 65% from its peak of Rs 530 to about Rs 160 as of mid-March 2025. That's a significant drop, bringing it close to its IPO price of Rs 142. Now on to the financials. The latest quarterly results for Q3 FY25 showed a consolidated net sales drop of 25.42%, year-over-year down to Rs 196.63 crore. Standalone sales declined even more, down 43.42% to Rs 147.70 crore. In Q4 FY24, the company reported a loss of Rs 48.97 crore, a stark contrast to the profit of Rs 63.92 crore in FY24. These figures signal some serious operational challenges. What about market sentiment? Sentiment on platforms like X and among analysts is mixed. Some see potential long-term gains due to Exicom's leadership in EV charging, with a 60% market share in residential chargers and 25% in public chargers. But there are also concerns about corporate governance and operational setbacks. When we look at valuations, Exicom has a market cap of Rs 416 crore, and a PE ratio of -130.79, reflecting its losses. Its price-to-book ratio is 3.68, suggesting the market still values its assets or growth potential. So, why might now be a good time to buy? First, the long-term growth of India's EV market looks promising, driven by government policies aiming for 30% EV penetration by 2030. Exicom's position in charging infrastructure could be a strong asset as adoption picks up. Also, the 65% drop from its peak might indicate an oversold condition, making it appealing to value investors. Plus, strategic moves like investing in a new plant in Hyderabad and focusing on renewable energy solutions could set Exicom up for a rebound. However, there are reasons to be cautious. The recent sharp sales decline and losses raise red flags about the company's execution and reliance on a few key customers. Competitors like Tata Power are putting pressure on Exicom, impacting margins and market share. Uncertainty around corporate governance and internal issues also looms large. And let's not forget the broader market context. The Indian market has seen a 13% correction from its 2024 peak, adding to the volatility. So, what should you do? For long-term investors who believe in India's EV growth story and can tolerate risk, current levels around Rs 153, 160 could be a bargain. I'd recommend accumulating gradually to average out volatility, with a stop loss around Rs 130, 140 to limit downside. For short-term traders, the lack of clarity on recent losses and governance concerns makes it risky right now. It might be wise to wait for the next earnings report or signs of stabilization before entering. Remember, given the stock's volatility, allocate only a small portion of your portfolio to Exicom and diversify with more stable large-cap EV plays. In conclusion, it's not a clear yes or no moment. The current price reflects distress, but also potential. If Exicom can address its challenges, it could be a speculative buy for risk-tolerant investors with a 2-5-year horizon. If you're cautious, hold off until the next earnings provide more insight. Always align this with your financial goals, and consult a financial advisor for a personalized take. Thanks for watching. If you found this video helpful, give it a thumbs up and subscribe for more investing insights. See you next time.